all the same problems are happening in the second quarter. In terms of recession risks, where are we right now?
Well, I think the recession risk is actually becoming more and more serious because more and more central banks are much more focused now on fighting inflation. I think the message coming out of Jackson Hole is basically you should basically front load your rate adjustment. There's no value to waiting. So we've had a lot of jumbo rate hikes, and obviously the worry about how that's going to transmit to economic activity is a big concern. And of course, because of the Fed out hawking a lot of people, because the economy in the U.S. is actually a lot more resilient, it's kind of amplifying the dollar's strength, which is making it harder for central banks on the receiving end of the depreciation pressures to also not become more hawkish, because obviously it influences policy. And that's where we are. So we are going to more and more, we've been adjusting our policy rate adjustment a little bit more on the hawkish side, even though recessionary risks are getting larger and larger. So essentially, stagflation narrative is becoming a pretty dominant narrative at the moment.
And you mentioned about intervention. We've seen 3 out of the last 4 major economies outside the U.S. basically go through some major interventions last week. Does it make you any convinced that maybe there is going to be some sort of concerted coordination that needs to kind of reverse the moves that we're seeing in the dollar?
Well, I mean, normally if you think about coordinated intervention, say coordinated FX intervention, you have to also believe whether the Fed or the U.S. is uncomfortable with dollar strength. And at the moment, it seems like the Fed seems to be okay with dollar strength. That is basically the intended transmission mechanism of its policy tightening by allowing stronger dollar to drive down disinflation. So if the Fed is pretty relaxed about, having the dollar strengthen, it's not clear to me a one-sided intervention will have a lot of kind of lasting impact.
There's a lot of, I guess, that word of crisis being thrown around. We're getting a whiff of Asian financial crisis, or some of these superlatives in the price action we've seen in currency markets. Do you think we're actually quite there, or are we just forgetting how, what a global tightening kind of feels like?
Well, obviously the market is very nervous, right? Because anytime you tighten, not just on policy rate, at the speed in which we're tightening, but then we also have liquidity adjustment in terms of quantitative tightening, you worry that something will break. I mean, clearly we're already seeing a lot of stress on the more fragile emerging markets. So you have these kind of smaller, kind of middle, lower income economies that do have pressure. So you see all these pressures of default, distress. But so far, those are smaller, lower middle income economies that are not yet we don't have any major, large emerging market countries that are under distress. But clearly, I mean, the stuff that we're seeing now with, these banks, CDS, Credit Suisse, et cetera, people are just worried about potential financial stability risks that are happening.
What does this mean for central banks in the region? I know you're talking about Korea, and you now forecast they could be in some sort of recession as well. At what point do you think that central banks are going to have to shift the focus away from just fighting inflation and more towards boosting growth?
At the moment, it's still too early, right? Because, I mean, we just had these news about OPEC. I mean, even though we are seeing a lot of headline inflation, maybe close to peaking in our region, or actually coming off, we still have underlying core inflation momentum that is still quite sticky. In some places, like, for example, Malaysia or Singapore, it's still picking up. So it's very hard for central banks to really pivot at this point. They're probably still going to be quite hawkish. And even though activity definitely is slowing down, I guess the question is it slowing down fast enough to cool inflation? And at the moment, I think in the short term, I think central banks are still going to be hawkish. We don't have, at the moment, our view is the Fed is going to continue to hike until first quarter of 2023. So in that backdrop, it's probably hard for anyone to turn dovish when the Fed is still hiking. I guess the question is after that, if we do start seeing the end of the rate hiking cycle in the U.S., and because we are also expecting a U.S. recession in the second half of next year, to what extent are central banks going to pivot? And in Asia, I mean, I think the places where we're going to look at are places where interest rates or policy rate is already above neutral or headed above neutral. Economy is very vulnerable to the slowdown, not only due to global kind of goods and manufacturing slowdown, but the slowdown from the kind of the impact of the transmission of higher interest rates to the domestic economy. This is where places that have very high household debt, very sensitive to interest rates. So Korea is one in our radar where we expect, Korea, we've just downgraded. I think outside of frontier, it's the first economy in Asia where we kind of really have a baked in a recession in the second half of this year. So we're thinking maybe Korea, after hiking rates up to 3.5%, which is a terminal rate, we could actually see Korea start cutting in the third quarter of 2023, so ahead of the Fed. And there's a few emerging markets that also can cut ahead of the Fed. And these are emerging market or central banks that have hiked earlier than the Fed or hiked a lot more.